Welcome to Akin's Emerging Manager Minute. I'm Max Karpel, a partner in Akin's Investment Management Group.
And I'm Kustin. Our topic today is managing SMAs alongside commingled hedge funds.
Some of the best hedge fund launches we're seeing today start with one or two separately managed accounts alongside a commingled fund. It's a smart way to build scale. Ideally, you want to start with at least $100 million under management, preferably 150 or more. That really makes the economics work.
Right. So SMAs offer flexibility, custom mandates, tailored liquidity, and often just run pari passu alongside a commingled fund. But running them next to a fund, that's where things get complicated.
First, expenses. You've got to allocate costs fairly between the fund and the SMAs. That means clear policies, who pays what and why.
And those policies need to be disclosed in your PPM. Investors want to know how their dollars are being spent, especially when other vehicles are in the mix.
Regulators are watching too. You have to think about material non-public information and how it flows between accounts.
And Reg M, if you're trading around offerings, you need to be careful not to violate restrictions on market manipulation.
Then there's the operational side. Running parallel portfolios means that you need robust infrastructure and a customized allocation policy. One size does not necessarily fit all.
Transparency is another issue. SMA investors often get asset-level visibility and veto rights. That can clash with the expectation of commingled fund investors.
And don't forget platforms. Many run center books, which can create complexity around trade allocation and even raise other concerns.
And even with those complexities, platforms can be great partners, but you need to understand the dynamics and document everything properly. In today's world, there's a twist. Many managers are running SMAs alongside commingled funds, and SMAs by nature can be terminated at any time, and that can create dislocation.
Exactly. If an SMA investor pulls out, the expense burden shifts to the remaining investors. You're spreading fixed costs over a smaller pool of capital, which can be a real issue, especially if the SMA was covering a meaningful portion of the overhead.
It's another reason why thoughtful structuring and clear disclosure are so important. You want to protect the integrity of the commingled fund and ensure fairness across all investor types.
SMAs and commingled funds can absolutely coexist, but it takes planning, transparency, and the right legal framework.
And that's where we come in, helping managers build platforms that scale without compromising investor trust.
Thanks for joining us, and see you next time.